Like a cronut?
I think that's a good point. The first thing I thought of when I heard this phrase was cronut.
You thought cronut?
Yeah, and then I've discovered that cronuts are no longer a thing.
No. They were a fad for about 15 minutes. 15 minutes of fame they had. Croissant meets donut. It also kind of sounds like Crexit, which I think is quite apt for this story we're going to cover.
The stuff they sprayed in the water in the Gulf after BP blew up a pipeline.
Yes. So BP's pipeline, the Deepwater Horizon in the Gulf of Mexico off of Louisiana, blew up. There was oil all over the top of the water, and that was an ecological problem. So what they did is put Crexit on it, which did not make the problem go away, by the way. It is just toxic chemicals which sank the oil to the bottom of the sea. The problem with the ecological problems are still there, but the Crexit made it disappear to the human eye. Not to the dolphins and the turtles and all the other things there, but here is a story regarding Crexit. Is a Crexit next? Global company debt will swell to $75 trillion through 2020. As companies drink at the open spigot of cheap borrowing from global central banks, company debt the world over will likely swell to $75 trillion by 2020, up from the current $51 trillion. That's a top-heavy accumulation that leaves S&P Global Ratings analysts introducing a new risk with a familiar nickname. A Crexit could rattle credit markets.
Oil and credit, they've grown up together over decades because oil business requires a lot of capital, which means a lot of borrowed capital, which means a lot of credit, and it drives trillions of dollars of credit growth and the fees that come with it and the GDP growth that was part of it. But now we're at that point in the credit oil history where the credit is now never going to be paid. My understanding is if they were to extract the 1 trillion barrels left in the crust of the earth and burn it for GDP growth, the resulting tax revenues would not pay down the current debt load. Therefore, we're at the end game. We're over the event horizon. We've reached the apocalyptic end of the Crexit scenario.
Yes, there is a story out there actually that risky loans in the U.S. the number is increasing. And it has a lot to do with oil and gas, i.e. fracking in particular, the fracking industry, as we've warned about for years. And of course, a lot of people don't like to hear that. They think it's some sort of propaganda, but the data doesn't lie. The risky loans are going bad as we speak. There is, it's almost at 2000. Right now, we're at 2009, the peak bad credit days of the last financial crisis. We're already at the same rate of bankruptcies as they had, even faster. So we're going faster than at the worst bit of 2007, 2008, 2009 financial crisis.
Didn't they try to stop the gas leak in the BP Deep Horizon by stuffing with cronuts?
No, so golf balls.
Oh,
and hay.
golf balls.
Yeah, golf balls and hay.
I thought that maybe it was cronuts. But you bring up an interesting point. The solution, the Crexit of the last crash in 2008 was more cheap debt.
Yes.
Which has created a much bigger problem.
It's just pushed all the bad debt out of sight of the human eye, i.e. the investor, and you can clearly see that the investor, as markets are hitting all-time highs in all markets, that they're not, they think they don't see it, or they have an illusion.
Right, these corporations have a word for it. It's called off-balance sheet debt.
Yeah.
So when they accumulate a huge debt that they don't want to include in their reporting on their 10K or their 10Q, they'll say, well, it's off balance sheet. And just like the phantom economy is bigger than the real economy, just like the black market for derivatives is bigger than the visible market for derivatives, this off-balance sheet debt is much bigger than their on-balance sheet debt, so it's become inverted. We live in a world where people are buying bonds for capital gains and buying stocks for income. That's a complete repudiation of everything we've known about economics for 200 years and an inversion of how things work, and will lead inextricably to devastation.
Yes, we covered that last week from Kingston, New York, and now I also want to point out that just like in the 2007-2008 crash, a lot of people came out to cover their behinds. Regulators warned right ahead of time, like only a few weeks too late, that there are a lot of dodgy loans in the system. S&P, who we spoke to actually for a documentary we made, warned about private equity at the time, all the bad loans that they were taking on, and here we have S&P again warning that things are looking pretty bad. And what they say is central banks may be trying to reinflate their economies, but they're doing so to the detriment of credit quality, the S&P Global Ratings said in a report. Quote, central banks remain in thrall to the idea that credit-fueled growth is healthy for the global economy, S&P analysts said. Quote, in fact, our research highlights that monetary policy easing has thus far contributed to increased financial risk, with the growth of corporate borrowing far outpacing that of the global economy. And this is, as Keiser Report has been saying since 2009, that this is exactly what was happening. On the surface, it all looks great because the stock markets are hitting all-time highs. Yields on bonds are hitting all-time lows. All of this stuff makes everybody happy, and they think it's great. But as S&P is saying, it's actually it's creating a huge amount of risk that will blow.
As I told Danny Blanchflower years ago, the monetary solutions to the credit crisis by creating more debt and credit was causing, not fighting, deflation. I've been proven right. What you're describing there is deflation. The situation is imploding because there's no growth sufficient to create revenues from tax to pay down debt. And the policy response has been to do more of the same. And the result is all the Crexit in the world is not stopping an eco-holocaust. In this
case,
everybody's
doing it. So from the central banks to the corporations, and the corporations, remember, they get paid, their own salaries and their own annual bonuses are based on their stock price. And with rates so low, interest rates so low, they are borrowing at record amounts in order to buy back shares of their company in order to inflate the price. But again, non-GAAP reporting, non-GAAP earnings, all sorts of massaging of the data, Microsoft being one of those. For example, we've covered this with Wolf Richter, who he was showing that Microsoft is now trading at 55 times earnings. If you look at the GAAP measures, if you look at the non-GAAP stuff, i.e. the stuff that they can make up that aren't actually official accounting standards, that everything looks great. But here we have this Crexit sort of situation on all levels of the financial system, from central bank down to corporations reporting earnings. That
mostly we talk about central banks, and now we're talking about corporations. Just to give you an idea of how it works, a CEO of a corporation can give themselves an option to buy the stock. Let's say the stock's worth $100 a share. They are given an option to buy that stock, and they carry the cost of that option at $1 to buy the stock at $100. So now the stock goes to $150 because they bought a lot of stock back on the open market using free money given to them by the U.S. government. Well, now that dollar option is worth $50. So that's how come they're making billions and billions of dollars, is because of the leverage involved in the options market. You're putting up pennies to make lots and lots and lots of $10, $20, $50, $100 per penny of an option price, and it's in their interest to keep giving themselves those options and to buy back stock, to award themselves these huge outsized bonuses by gaming the system, even though it means ultimately the collapse of the system.
Speaking of the collapse of the system, the last financial crash was really about the U.S. and the U.S. subprime market and all the bad debts here. This time around, it very much looks like it's Europe. The Italian banks, they could have collapsed by the time we're, between recording this and transmission, because it's happening so fast. They've had their stress tests. They failed all the stress tests. All their shares are, limit down all the time. But there's the rich area, the industrial heartland, the manufacturing, all the wealth from Italy comes from the northern part. And one of the richest is Vicenza, the area around Venice. Vicenza, dark heart of Italy's banking crisis, where locals have lost millions. The collapse of BPV has left citizens with nothing, and the ramifications could damage the whole of Italy and the Eurozone. So that's Banco Popolare di Vicenza, and its collapse. A lot of the locals were invested in their local banks. Remember, there's this whole drive of move your money, move to a local bank. Well, this was a local bank, and all of basically, what we've seen is a lot of Italians were moved into products that they didn't know, that the risk involved, and they lost everything. Well, the mayor, who is Achille Veriati, we need our Italian crew here. There is some Italian people, but
where's Bruno?
Who can explain to me how?
He's over in Naples.
Well, he's the
Florida.
mayor. And he says, this bank BPV, they basically provide all the funding for 30% of Vicenza's 100,000 companies. Now they're disappearing. They're bankrupt. They've been bailed out by the central government, by the way. But what I hope as a mayor is that the bank stays as close as it can to the companies. Those 30% cannot be abandoned. They have to be supported if they are healthy. BPV will be able to survive over time if the territory is strong. There will be no future for the bank if the territory is poor. This is one of the richest territories of Italy. If this territory stops, there will be problems for all of Italy. Again, this ties in with this problem of Crexit, this creating the illusion that all is good, but when at the heart of it is the actual wealth of the ecology of the economy is the same, is that it's all deteriorating rapidly at the bottom.
Well, we more or less covered this. During the Greek financial crisis, we said that the IMF, part of the Troika were corrupt, and they had marked Greece for death. Now it's come out finally. Christine Lagarde's involved in another massive scandal.
Yeah, but on Italy, so Italy is way bigger.
And they said after they destroyed Greece, they would either go and destroy Italy or Spain. So, okay, they chose Italy to destroy next.
Italian banks also did their fair share of making bogus loans and loans that were never going to be repaid, and this is the problem that's happened here. Something like 18% of all loans in Italy are not being paid back. 18%. It's about 5% in France, like 1% in Germany. So it's a huge
hedge funds
problem.
made billions attacking Greece. They'll make billions attacking
Italy. They will, now that it's
then they'll make billions attacking France.
Yeah.
As France kind of slides down into the
Exactly.
tar
But
pit.
just like the last crisis, it comes down to hope. Hope and change. That's what everybody's got. Because in the last few minutes in the town hall, Variati, the mayor of Vicenza, says that the city would survive. Is there a shock? Yes. But us Vicentini are a tenacious people, used to working and resolving problems ourselves and rolling our sleeves up. In other parts of Italy, people would have cried and screamed. Here there's pain, but we want to go ahead. But we ask and expect justice.
Well, maybe the Pope will help. Stacey, you've got to go. Thanks.
Hopefully they'll get some justice, because that's all they have is hope that there's some sort of attorney general that would follow through on the justice. But likely they'll just go after the little guys, the little businesses in Vicenza, just like they did in the rest of the world.
All right. Stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time to return to our conversation with Francine McKenna. She's the transparency reporter for Market Watch. Francine, welcome back to the Keiser Report.
Thank you.
All right, what is a transparency reporter?
Well, I work at Market Watch, which is part of Dow Jones, and I'm supposed to be writing about financial regulation and legislation from a transparency perspective. In other words, getting into the stories that other people don't have time or the subject matter expertise to write, sort of digging in and tying things together.
We are 8 years into one of the biggest stock market booms in world history. Regulators warn that the too big to fail banks have been making risky loans again. You've been writing about it. What's going on?
Well, you can write the stories of every report from the Fed, from the FDIC, from the OCC. 1 minute they're telling you that they are not making as many loans to commercial borrowers. We're having trouble getting real estate loans out. And the next minute they're saying the loans they are making are more risky. So it looks like all the complaints about not enough lending to small business, not enough lending to big business, not enough lending, period, is true. And the loans that they are making are still to oil and gas, structured products, hedge funds, other kinds of leverage products like private equity. Why? Maybe the fees are higher. I don't know, but they're not lending to middle America. They're not helping build business.
Okay, we have a market metric that tells us exactly in pictographic form what it is of which you speak, and that would be the money velocity figure. Money velocity tracks money velocitating in the economy, banks lending, and then that deposit going into another bank, who in turn lends it out again, and you see the economy working as it should be. That money velocity number is at historic lows, son of what you're saying. They're not lending the money out. And it opens up this very interesting quandary, because on one hand, they need the loans to stimulate enough growth to generate the income to pay down taxes on the debt. However, they are risk averse because the bank's balance sheets are so fragile that if they make a bad loan, you could declare bankruptcy in every major bank in America and around the world. So they've backed themselves into this historic corner, a fragile corner. Would you agree with that assessment?
Yes, and the banks blame the stress test. They blame Dodd-Frank. They blame all of this additional regulation that says now they need to keep more capital. And there have been very outspoken people like Adnat Ahmadi from Stanford talking about how they should keep more equity, not keep more debt on their books. They want to lend money, but only on the terms that they want to lend it on. And they don't want to raise equity. The stress tests are something that they should be doing. They need to be doing. This is the kind of early warning that we needed before the crisis. But they don't want to do it, and they complain, oh, you know, the Fed and the regulators are not telling them what's going to be on the test. Well, that sounds like a 5-year-old.
Okay, so in other words, they're saying the bank's response, and between this the conversation that's going on, is that on one hand, it's being pointed out that their balance sheets are fragile and woefully lacking in reserves, and that they should begin to repair those balance sheets in a way that would make economic sense. Their responses, or the conversation, is about, well, you should have higher equity values, as to say you're going to have to sell some stock. Mm-hmm. You're going to have to sell stock in your company, which would mean that the value of the stock goes down because you're flooding the market with more equity or more stock. That would mean that Jamie Dimon's bonus gets cut. That means Lloyd Blankfein's bonus gets cut. That means Warren Buffett's bonus gets cut, or his crony and his buddies. In other words, they want to game the system. Again, they're mafiosa. You know, if the government came to the mafia and said, we want you to stop killing people, the mafia would say, well, we kill people for a living. That's how we work.
The velocity they like is how fast the money goes into their bonuses, how fast the money goes into their stock option valuation when they can get the stock price to temporarily go up. It's all about gaming compensation. And now we're seeing not just the banks, but commercial companies gaming the way they're reporting to the market in order to make it seem like they have better results. And it's gotten way, way, way out of hand, the non-GAAP metrics that they're using in order to try to fool the investor that they're really doing better. And they're using those kinds of metrics.
Okay, let's talk about non-GAAP for a second. But just to get to this point, when a large banker like Jamie Dimon or Lloyd Blankfein say, oh, we've now reached the status of billionaires, that's money that's been taken from the economy, extracted from the economy. It's not money they earned by providing the service of banking. It's money they nickel and dimed out of America through pilfering.
Almost all of them were complaining in this earnings season that they were making less because of the low interest rate environment. How in the world do you make less on a low interest rate environment? You fund low and you lend at a reasonable rate, at any rate that's more than zero. I don't understand how they can get away with a complaint that they're making less money, that their profits are depressed because of the low rate environment. It would seem like an ideal situation in order to ramp up lending, especially to small and medium-sized business.
Okay, let's talk non-GAAP. In other words, what is GAAP, first of all, and then therefore what is non-GAAP?
GAAP is generally accepted accounting principles. That's the standards that all companies that report to almost any major stock exchange, not just the United States, but the set of accounting standards that say, predictably, consistently, across any company in any industry, we know what this particular figure means: net income, earnings per share, revenue, etc. But companies are just gone way, 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 way out on a limb in terms of all the things that they're making up in order to try to report their earnings better. I reported yesterday on ConocoPhillips, who doesn't even put a revenue number in their press release for their earnings. Why? Obviously because it doesn't look very good. So they focus on other kinds of metrics that they can manipulate each quarter inconsistently as it meets their needs in order to accomplish their goal.
So when a Big Four accounting firm is hired to do the books on a company like Conoco, and their report has some meaningful omissions in it, they in turn can point to the government and say, well, it's not required.
Exactly. On the press release, all you have to do is make sure that if you include all kinds of non-GAAP metrics, all kinds of operational and financial measures that the company makes up in order to look better, that you mention the GAAP ones also, and hopefully as prominently and on the same page in a reconciliation. But you have to mention them. And I've been writing story after story talking about how these companies need to get on the program. And the SEC actually has a task force where they're going to start writing letters to companies. But it goes back to your comment in our first segment about going after the small guys. They've gone after sort of the cosmetic and the format of some of this kind of reporting, and not after some of the more egregious situations where banks or other large corporations are just making things up out of thin cloth, especially the technology companies. They keep reporting numbers that are really not meaningful and not consistent from period to period in their own company, let alone compared to other companies in their industry.
So you've been writing recently about bad loans. And so are we analogous to a situation back in the 2006, 7, and 8 period of the subprime era, the liar loans, ninja loans, where the entire system came down because banks were making loans that should not have been made to simply feather their own nests?
Well, it's hard to say if it's the same kind of criminality, the same kind of fraudulent approach. But what they are doing is they're making very risky loans to private equity, to hedge funds, and to oil and gas companies still. The difficulty is on a bank balance sheet, it's really, really hard to see the total exposure that the banks have to these loans. They're saying that it's not as much as in the pre-crisis era.
Whose office does this fall under in the government to clean this up? Is it the office of the controller, the budget office, the treasurer?
With public companies, it would be the SEC's Division of Corporate Finance. That's the group that every time a company files financial statements each quarter, they have to review it and see if that company is following the rules in terms of both how they're reporting and how they're disclosing.
All right, fair enough. Now, PricewaterhouseCoopers, one of the big agencies, accounting agencies, they're feeling the heat in Miami in a trial regarding Taylor, Bean, and Whitaker fraud. Who are the players? What's the case? What's the significance?
Taylor, Bean, and Whitaker was a huge fraud during the crisis era. It was one of the biggest loan originators down in Florida. And, well, actually, I think they're in the South, in Atlanta. And Colonial Bank, also down in the South, was in cahoots with them and making sure that they were able to create the loans and put them on the books in both banks. Both banks had executives that went to jail. PwC audited Colonial Bank. Deloitte audited Taylor, Bean, and Whitaker. Deloitte's already settled a lawsuit from the FDIC, who had to take over both Colonial Bank and Taylor, Bean, and Whitaker. They've already settled a suit on that. But now there's a lawsuit against PwC by the trustee of Taylor, Bean, and Whitaker saying they should have caught the fraud at Colonial Bank, and then Taylor, Bean, and Whitaker, the co-conspirator, would not have had the losses that they had. It actually is going to trial. It's an incredibly rare situation. The big four public accounting firms always, always, always settle. And the reason is because once you start getting to depositions and documents and other kinds of discovery, the firms and their partners tend to say things that you would be surprised at, that they don't really realize. And the reason is because they're not in public very often. We don't know who the partners are at the largest companies for their audits. We don't know who those people are. They can hide sort of in obscurity and say and do things, and when they have to go to trial, all of that comes out of the woodwork.
When was the last time we saw something go to trial that was brought?
Well, this same lawyer, Steve Thomas, who's trying the case for Taylor, Bean, and Whitaker's trustee against PwC, just won a case against Ernst & Young in Washington State for a Madoff-related feeder fund. He actually brought Ernst & Young to trial. It was the first one of almost all of the feeder fund cases and the only one against an auditing firm that went to trial, and he won.
All right, so clearly that would be a quick question. You know, when the big four accounting firms get together and they have their conferences and they discuss their industry, do you ever hear about collusion?
Well, you know, I've written in the past that I think that the vehicle that they use in order to have those kinds of discussions, if they have them, is something that came out of the Enron era. Sarbanes-Oxley required independent regulation of the accounting firms after the failure of the failure of Enron and Arthur Andersen. And there's a group called the CAQ, the Center for Audit Quality, that's in the AICPA, which is the Auditors Trade Association. And that's where I think they get together and have bourbon and cigars and talk about their strategy in terms of which audits they're going to do and how they're going to work together and what kind of approach they're going to take to things like when the Chinese reverse merger frauds came up and they were all under indictment for how they addressed those issues. I think that's where they got together and hired the same lawyer in order to represent them.
Francine McKenna, we have about 40 seconds. Can you do a quick answer? We have about 40 seconds. Facebook and the IRS, what's going on?
Facebook is being sued by the IRS. They're under investigation, and they've been actually very, very, very stubborn, not wanting to cooperate. They just basically don't show up. But they're not the only ones. Amazon is also facing a potential decision on an IRS-related tax avoidance issue related to